Hello everyone and welcome to the sixth video in our series 6 of the video tutorials on technical analysis. We've been covering various chart patterns and how they can be used as trade signals in our previous videos. And as in continuation to that, this video today will be covering another commonly used chart pattern known as the double top and the double bottom formation. Double top and bottom formation can also be extended to triple tops and triple bottoms, since the underlying principle behind their formation and their use as a trade signal remains the same. So we start with the double top formation. Double top is a trend reversal pattern which marks the potential end of an ongoing uptrend. Identification of this pattern in a price move is considered as a bearish signal indicating a trend reversal from buying towards selling. The components of a double top pattern are as follows. It requires the formation of two heads, the top line joining these heads, and a neckline. We will now discuss this pattern in more detail. The formation of double top begins with the formation of the two heads at the successive highs in a given price move. The first head is formed in continuation to an ongoing uptrend at its highest point or the peak. The price then retraces lower from the high of the first head to make a new low. This completes the formation of the first head. From this low, the price then climbs back to higher levels, forming the peak of the second head at the new high. This new high must be formed at or close to the same price level as the previous high of the first head. After the formation of this high, the price then slides down towards lower levels, completing the formation of the second head. The line joining the peaks of these heads is what is known as the top line, and the horizontal line passing through the low formed after the formation of the first head is known as the neckline. This completes our double top pattern. Now that we know how to identify a double top formation, we shall see how to use it while trading. Once the two heads have been identified, the next step is to identify the neckline. The neckline is the horizontal line through the first low after the formation of the first head. Once the price of the financial instrument breaks below the neckline, it is considered a confirmation of the double top formation. The neckline acts as a support line as long as the price of the instrument is trading above it. The top line is formed by joining the peaks of the heads. If the price takes support at the neckline and breaks above the top line from below, then the double top pattern is said to have been breached and will no longer hold good. If, however, the price breaks below the neckline, the pattern is said to have been triggered and it is considered as a sell signal. The price is expected to slide down to lower levels by at least the minimum objective of the pattern. The minimum objective is calculated as the perpendicular distance between the peak of the heads or the top line and the neckline of the pattern. Let's have a look on the trading platform to understand this formation and its working better. Consider the example of the Aussie dollar over the 4-hour time frame. We identify the double top formation here on the chart. As you would notice, this pattern emerged in continuation to an ongoing uptrend, marking its potential end and a trend reversal from buying towards selling. These points here are the two heads of the pattern, formed by two successive highs. Joining them would give us the top line of the pattern. As explained, the first head is formed in continuation to the uptrend at its highest point or the peak. After making the first head, at the peak of the uptrend, the price slid lower, making a low at these levels here. In this case, there were two successive lows made around the same price level before the formation of the second head at this new high. The line through these lows forms the neckline of the pattern. Notice that this new high is at the same price level as the previous high. Now from this point, the price again slid towards lower price levels. The neckline would act as the underlying support, while the top line acts as the overhead resistance. Once the price breaks out below the neckline of the pattern is said to have been triggered. A considerable decline below this level is considered as a sell signal. The price is expected to drop to lower levels by at least the amount of minimum objective of the pattern, which is the perpendicular distance between the top and neckline. In this case over here, we can also identify a triple top pattern formed by three successive highs at the same price levels. Here also, once the price breaks out below the neckline, it is considered as a sell signal and the price is seen to have dropped down by at least the amount of the minimum objective, which is the perpendicular distance between the stop line and the neckline. Next, we have the double bottom formation. Double bottom is a trend reversal pattern which marks the potential end of an ongoing downtrend. Identification of this pattern in a price move is considered as a bullish signal, indicating a trend reversal from selling towards buying. The double bottom pattern consists of two bottoms, the bottom line and a neckline. Let's discuss this pattern in more details now. The double bottom formation begins with the formation of the two bottoms at successive lows in a given price move. The first bottom is formed in continuation to an ongoing downtrend at its lowest point or the low. The price then retraces higher from the low of the first bottom to make a new high. This completes the formation of the first bottom. From this high, the price slides back to lower levels, forming the second bottom at the new low. This new low must be formed at or around the same price level as the previous low of the first bottom. The line joining the lows of these bottoms forms the bottom line of the pattern. The horizontal line through the first high after the formation of the first bottom forms the neckline. This completes the formation of the double bottom pattern. Now that we know how to identify the double bottom formation, we shall see how we can use it while trading. Once the two bottoms of the pattern have been identified, the next step is to identify the neckline. The neckline is the horizontal line through the first peak or high after the formation of the first bottom. Once the price of the financial instrument breaks above the neckline, it is considered as a confirmation of the pattern formation. The neckline thus acts as a resistance as long as the price of the instrument is trading below it. The bottom line is formed by joining the lows of the bottoms. If the price takes resistance at the neckline and breaks below the bottom line from above, then the double bottom pattern is said to have been breached and will no longer hold good. If, however, the price breaks above the neckline, it will trend higher by at least the amount of the minimum objective of the pattern. The minimum objective is calculated as the perpendicular distance between the bottom line and the neckline. Let's have a look on the trading platform to understand the formation and working of this pattern better. Consider the example of the GBP USD over the daily time frame here. We identify the double bottom pattern at this point on the chart. As you would notice, This pattern emerged in continuation to an ongoing downtrend, marking its potential end and a trend reversal from selling towards buying. These points here are the two bottoms of the pattern formed by two successive lows at or around the same price level, and joining them gives us the bottom line. As explained, after making the first bottom at this point, which is the low of the downtrend, the price trended higher, making a high at this point, and then slid lower to form the second bottom at this low. This completes the formation of the double bottom pattern. The price again trends higher from this bottom close to the previous high. The horizontal line through this high between these two lows forms the neckline. This neckline acts as the overhead resistance, while the bottom line acts as the underlying support. Once the price breaks out above the neckline of the pattern is said to have been triggered, and it is considered as a buy signal. The price is expected to rise to higher levels by at least the amount of the minimum objective, which is the perpendicular distance. So this is how we can use a double bottom pattern as a trade signal to initiate trade positions. A double top pattern acts as a bearish signal, while a double bottom acts as a bullish signal. With this, we come to an end to this tutorial on the double top and double bottom formations. Thank you again for taking the time to watch this video.